Did you know the ITO gives you the exact tools you need to save you anywhere from a few thousand to over 20,000 in tax on your next tax return? Maybe you are earning a good income but getting hit with a massive tax bill every June. Or you've had a big financial year, sold a property, got a bonus, and you are dreaming what you'll owe. The solution is in your superannuation. I'm Krishan Sharma from KNS Accountants, and over the past 10 years, we have helped hundreds of business owners and individuals legally reduce their tax bills using superannuation strategies. And in the next 10 minutes, I'm walking with you through the exact 5 methods we use with our clients to save them hundreds to thousands of dollars on their tax bill, all by using this super. By the end, you'll have a clear action plan for what you can do before June 30th to pay less tax this financial year legally. Let's get into it. Strategy 1. Concessional contribution. The first tax saving super strategy we recommend clients start with using salary sacrifice or personal deductible contributions. Let me quickly explain what this term means. Salary sacrifice is when you arrange with your employer to redirect part of your pre-tax salary straight into your super fund before it's taxed. Personal deductible contributions are when you put money from your own bank account into super after you've already been paid. Then you claim it as a tax deduction on your tax return. Right now, you can contribute up to $30,000 per year into your super as concessional contributions. These are contributions that either go in before tax, like salary sacrifice, or you can claim a tax deduction for them. Inside your super fund, those contributions are taxed at 15% compared to your personal tax rate, which could be 32.5%, 37%, or even 45% if you are a higher income earner. I'll give you an example. Let's say you earn $120,000 a year. Your employer pays 12% super, which is about $14,400. That leaves you with $15,600 of unused concessional cap. Now, if you are sitting in the 37% tax bracket, you are paying $37 in tax for every $100 you earn. But if you salary sacrifice or make a personal deductible contribution of that $15,600 into your super, you only pay 15% tax on it inside the super fund. That's a tax saving of 22% on the money. At $15,600, the roughly $3,400 in tax savings. But here's what most people don't realize. If you are self-employed or your employer doesn't offer salary sacrifice, you can still do this. You just make a personal contribution from your bank account into your superannuation, then lodge what's called a notice of intent to claim a deduction with your super fund. The trap. You must lodge that form before you lodge your tax return or before the end of the following financial year, whichever comes first. Miss the deadline and you lose the deduction. I have seen people contribute $20,000 thinking they'll get the deduction, then forget the form and end up paying full tax on their income anyway. So, if you are going to use this strategy, get that form in immediately after you make the contribution. Strategy 2. Carry forward concessional contribution. This is where these strategies can make all the difference, especially if you had a big income year. Since 2018, the ITO has introduced a rule that lets you use the unused concessional contribution cap from the previous 5 financial years as long as your super balance is under $500,000. What that means is that every year you have a $30,000 concessional cap, but if you didn't use all of it in previous years, you can carry those unused amount forward and use them now. Here's an example from an hypothetical client. Let's call him Dennis. Dennis sold an investment property this year and also received a redundancy payout. Between the capital gains and the payout, he had a taxable income of over $375,000 for the year. Normally, he'd be paying close to 45% tax on most of that. But when we looked at his super history, we found that he had about $45,000 in unused concessional cap from previous 5 years. So we'd help him contribute not just the current year's $30,000, but also that additional $45,000, meaning he can put $75,000 into his super and claim the full amount as a tax deduction. At the $45,000 tax bracket, he saved over $200,000 in taxes. The catch here is that you need to check your MyGov account to see what unused cap you have available. The ITO tracks this for you and is listed under your superannuation information. Also, If your super balance is over 500,000, you can't use this strategy. Any unused caps from the 2018-19 financial year will expire at the end of this financial year. So if you have got used amount sitting there, now it's time to act. Strategy 3, non-concessional contribution. This one different in the sense that non-concessional contributions are after-tax contribution. You don't get a tax deduction for them, but there's still a reason they are so powerful they grow tax-free inside your super fund. This means that when you retire, move into pension phase, you can draw that money out completely tax-free. Think of it like this. If you've got savings sitting in a bank account and interest, you are paying tax on that interest every year at your marginal rate. But if you move that money into your super as a non-concessional contribution, the earning inside super are taxed at just 15%, and once you hit pension phase, 0. The cap for non-concessional contribution is $120,000 per year, but there's something called the bring forward rule, which lets you contribute up to $360,000 in one go if you are under 75 and your super balance is under the transfer balance cap. This strategy works well if you sold an asset, receive an inheritance, or you are approaching retirement and want to maximize your tax-free retirement income. Now, here's what you need to know. This contribution don't reduce your tax today, but they do set up for a tax-free retirement, which is over 20 or 30 years can be worth hundreds of thousands in tax savings. Strategy 4, spouse contribution. Did you know that if your partner earns less than $40,000 a year, you can contribute up to $3,000 into their super fund and receive a tax offset of $540. This is a straight up rebate on your tax bill, not just a deduction, and it's one of the most underused strategies I see. Here's how it works. Let's say your spouse earns $35,000, you contribute $3,000 into their super. Because their income is under $37,000, you'll get a full $540 offset, which comes straight off your tax bill. Even if they earn between $37,000 and $40,000, you'll still get a partial offset. It tapers down to 0 once it hits $40,000. The benefits here are twofold. 1, you reduce your tax. 2, you are building up your partner's super balance, which helps them in retirement. The trap. This is a non-concessional contribution, so it doesn't count towards your partner's concessional cap, but it does count towards their non-concessional cap. Just make sure they are not already maxing that out. Strategy 5, government co-contribution. This one's for lower to middle income earners, and it's generally free money straight from the government. If you earn less than $60,400 and you make a personal after-tax contribution of $1,000 into your super, the government will match it with up to $500. That's a 50% return on your money immediately, plus the tax-free growth inside the super. The co-contribution reduces as your income increases, and it cuts out completely once you earn over $60,400. But if you are eligible, this is one of the best returns you'll ever get. You don't need to apply for it either. The IT automatically processes it when you lodge your tax return, as long as you have made the contribution and meet the criteria. Like anything, there are still traps I see people fall into with these strategies. Let's break them down so you can avoid making the same mistakes. Number 1, missing deadlines. If you are making personal deductible contributions, the money must be in your super fund account by 30th June. And you need to lodge your notice of intent before you lodge your tax return. Miss either of those and you lose the deduction. Number 2, exceeding contribution caps. If you go over the $30,000 contribution cap without using carry forward amount, you'll pay extra tax. The ATO will assess the excess at your marginal rate plus the excess contribution charge. Number 3, not checking your super balance. If your balance is over $500,000, you can't carry forward contributions. Always check your balance before making large contribution. And finally, number 4, forgetting about employer contributions. Your employer super guarantee counts towards your concessional cap. If they are already paying $15,000, you only have $15,000 left to use. So here's my recommendation on what to do next. First, log into your MyGov account and check your unused concessional contribution caps. Look what's available from the last 5 years. Second, look at your projected income for this financial year. If you had a big income spike, a capital gains or a bonus concessional contributions are your best tools. Third, check your super fund balance. Make sure you are under $500,000 if you want to use carry forward contribution. Fourth, if you have cash sitting in savings and you are approaching retirement, consider non-concessional contribution to build up your tax-free retirement income. And finally, if you are unsure about any of these, speak to your accountant or financial advisor before June 30th. These strategies are powerful, but getting the timing and paperwork right is crucial. If you found this video helpful, make sure you subscribe so you don't miss our next one, where I'll be covering the biggest tax deduction people miss when running a business through a company structure. I'm Krish. Thanks for watching. I'll see you in the next video.